All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined, as always, by CNBC's senior stocks correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hi, Katie. How you doing?
Good. How about you?
It's been a long week.
I'm sure you've been busy. So let's jump right into it. As we said, it's been a busy week for the stock market. The Dow posted its worst day since 2020 yesterday. So what caused Thursday's massive sell-off?
Well, just think of what markets worry about. There's two risks to the market right now. One is really high inflation at persistently high levels, and the other is the Fed aggressively raising rates. So this combination is really a problem because the stock market does pretty well with moderate inflation, 2 or 3%, because companies historically have pricing power. They raise prices. And as long as it's not too crazy, they usually can get away with it. The problem with rapid inflation, when you go from, inflation to 8%, which is what we've done in the CPI and the Consumer Price Index, corporations lose the ability to price power because the consumers push back. I mean, think about this. Hershey bars. This is just one example. You could charge $1 for a Hershey bar, and maybe next year you could charge $1.02 or $3 or $4. But when you start charging $1.10, $15, $20, people start noticing it and pushing back, and it gets demand destruction. Corporations don't like that. So generally, the stock market does well with modest inflation and not well with rapid inflation. Then there's the problem with the Fed aggressively raising rates. This combination is a problem because when you have the inability to raise rates fast enough, you have profits erode, number one. And the Fed raising rates slows the economy at the same time. So wait a minute now. We've got high inflation, and then we might have no growth or negative growth. That's called stagflation. High inflation and no growth. That's what we had in the 70s, and that's why the market's kind of concerned here. I don't think the 70s is going to happen, by the way. I don't think we're going to get anything like that. But this is a sudden period of rapid inflation caused mostly by the whole COVID mess and a little bit about what's going on in China too, which is also somewhat related to, and also what's going on with Ukraine and Russia. So we've had these two double whammies here that have sort of thrown everything off. These were, I wouldn't say black swan events, but if I told you 5 years ago, there'd be a global pandemic that's going to cause massive supply chain disruptions and like 1 million people are going to die in the United States, I would have said you were crazy. But actually, that did happen. I mean, think about that. So we're dealing with the aftermaths of those two things, with the high inflation, and the market's worried about inflation at persistently high levels. So suppose we don't have to have higher inflation. If we have inflation at 8% going on for another year, that's a problem because it's going to erode people's purchasing power. It's going to erode corporate profits. So that's why the Fed's kind of very insistent on slowing the economy down to see if they can pull this off.
So, Bob, one part of yesterday's sell-off that people were asking about is the tech sector. Why did tech stocks get hit so hard yesterday?
Techs are very subject to what's called multiple compression. So technology stocks are classic growth stocks. So what's a growth stock? Well, a growth stock is companies where you think the earnings are going to be growing very fast in the future. There are different kinds of growth stocks. There's what we call mature growth stocks like Apple and Microsoft. These companies keep growing their earnings, and generally better than everybody else, but it's still pretty steady and they're well known. Then there's more speculative growth companies that are out there, a lot of software companies and companies that we saw during the pandemic, Cathie Wood stocks, that either have no real earnings right now. They don't make any money. You're buying them on the come. You're buying on the hope they're going to make money down the road, or they're barely profitable. They have what we call high multiples, 160 times forward earnings. They make, a nickel or 10 cents, and the stocks trades at $20. So when interest rates go up suddenly, and it looks like the economy is going to slow down, think of why people buy these stocks. Stocks are bought on a hope for a future stream of either dividends or earnings. That's traditionally why you buy stocks. And when the interest rates go up dramatically, the bond market competes with the stock market for money. At the same time, the Federal Reserve is withdrawing money that's in the economy, so there's less money around, and so that's an issue for the stock market. But it's particularly an issue for technology stocks. Remember, they have high multiples. What's a multiple? It's a PE ratio. A multiple is just what investors are willing to pay for a future stream of earnings revenues. We have multiples on the S&P. So right now, in the beginning of the year, the S&P was trading for 21, 22 times 22 earnings. You can do the math yourself if you want. Just take the S&P 500 and divide it by the current estimate for earnings for the S&P. It's about $228, and you'll see the number's gone down to 18 and a half, somewhere around there. So the multiples being compressed. This just tells you how much are you willing to pay for this future stream of earnings that are out there. And when the multiple will compress, will go down when interest rates go up dramatically and when the economy slows down. And that's what's happening. And most of this compression we're seeing this year is because of multiple compression. And tech stocks, because they have generally high multiples, you're paying for the hopes of earnings accelerating rapidly with these growth stocks, technology or classic growth stocks. That's why you're getting tech stocks hit a little bit harder. I hope that made any sense at all. Sometimes people look at me like I'm a little crazy, but this is the way the stock market thinks. Just remember, you're in the stock market. What moves stocks? You're paying for three things. Number one, you're paying for a dividend. The S&P doesn't pay much of a dividend right now. It's maybe 1.5%, but it's there. Second, you're paying for estimates for a future stream of earnings. And the question is the rate of change. Are earnings estimates going up or down? Corporations expected to make more money than they were a month ago or 2 months ago, or less money. And the third is the multiple. The multiple is the PE ratio. It's the speculative component. So now we know we got the earnings. Okay, how much am I willing to pay for those earnings? What kind of multiple? How many more times earnings am I willing to pay? And it fluctuates. It depends upon interest rates, the state of the economy. Sometimes people are willing to pay more, sometimes less. That's what's gotten hit this year. So if you look at those three components, you can figure out what the S&P is doing, what the change is. S&P is down 13, 14% this year. Dividend is about, let's say, 1%. Earnings growth, well, beginning of the year was 6, 7%. Now it's about 9%. So earnings growth earnings actually are higher. They're 2% higher. So we got a 1% dividend. Earnings are 2% higher than the start of the year. And the multiple's gone from like 21 to about 18. Do the math there. That's like, 16, 17% decline. So the reason the S&P is down this year is because the multiple has compressed. If you know that those three things are what makes the S&P move. So +1 for the dividend, plus 2% for the change in the earnings, and minus 16, 17% for the multiple change. And do the math on there, you get about down 13%. That's what the S&P is actually down. You can actually figure these things out sort of in your head. It's not an exact science, but it's a pretty good way of figuring out what's going on. So think multiple compression when you think these tech stocks.
Yeah, that's definitely helpful, Bob. So thank you for explaining that for everyone. So another event that happened this week, Wednesday, we had the conclusion of the Fed's May meeting. What did we learn? And we got another rate hike. So what does that mean for everyone?
This was a real head scratcher to me. I like to think that, I'm a Fed watcher for 30 years. I like to think I kind of know what they're doing. Jay Powell, we learned that Jay Powell is cautious and going slow. He said the Fed would like to raise rates likely 50 basis points, 0.5% at the next two meetings. The problem everybody had with this was most people assumed that the most important thing for the Federal Reserve was to maintain their inflation-fighting credibility. Most people feel the Fed is behind the curve and they need to be very aggressive raising rates. By essentially holding the market's hand and guiding the market and saying, listen, children, we're probably not going to raise rates more than 50 basis points at each meeting. We'll probably do 70. We're not going to do 75. He's giving very explicit guidance. And there were people out there who wanted the Fed to be more aggressive and deal with inflation because, as I showed you before, this is a problem for the economy and for the stock market. And I think a lot of people were very surprised that he offered that kind of very specific guidance. So you could say, to a certain extent, that Powell is even more concerned about creating a recession because he's raising rates too fast. He came out very specifically and said, I think we can get a softish landing. That means I'm hoping to avoid a recession. So it's obviously that he doesn't want to be blamed for starting a recession. So this is a delicate balance. I mean, it's very hard to fine tune this. You can't do it very well. Historically, it's not. You usually create a recession somewhere down the road. I was personally surprised that he came out specifically and said, we're probably not going to do. It's not really on the table, this 75 basis point hike. I think what we're dealing with right now is a Fed that's trying to engineer a softish landing, and the market is doubting that they can do that. So you see these signs with the 10-year yield. Watch the 10-year yield goes up. If it goes up faster than the 2-year yield, that's a sign. That's the 10-year is a long term. That's an inflation thing. When that starts going up, it shows you that there's signs about some concerns about inflation. And I think the market is having trouble believing that Powell is going to be able to engineer this softish landing that he's talking about. So they're doing what you would do. They're taking down the multiple. Because if you go into a recession, people aren't going to be willing to pay a lot more for a future stream of earnings. That's the multiple coming down. And earnings might itself go down. The earnings estimates might go down themselves. So, basically the market's kind of calling Powell's bluff here and saying, we're not sure you can necessarily pull this off.
Well, time will tell, I guess. So we'll have to wait and see how everything plays out here.
Yeah.
One other thing, Bob, is you've talked a lot about peak everything lately. And I was wondering if you could explain to everyone what you mean by that.
Yeah, I've been early on this, and I think that I'm right. As reporters, you look for very broad themes. I'm the stocks correspondent, so I look for very broad themes. And one of the things that's very clear to me is what I call peak everything. Now, this really started with Netflix, when Netflix came out and basically said, peak everything, peak streaming. The implication here is there's so many streaming services out there, everybody's been paying up for it, and it's a point at which everybody's going to stop. Netflix basically came out and said, it's looking like, slower growth here. That's peak. There's going to be people cutting back on these streaming services. I can't even keep track of them. I spend a stupid amount of money on it, and even I'm annoyed. And I work in this business. My wife loves old movies, so we have all sorts of things. So there's peak streaming. Then you had these airline executives coming on, these hotel executives saying, we can't believe the business. We're just raising prices like crazy. Now, this is going to stop, right? They haven't said business is deteriorating. They said business is great. But you have a brain, you watch the trend here, people are going to push back against this eventually, So I think this is going to be peak travel this summer. And then you have Zillow today, peak real estate. Zillow, real estate company, peaking for demand, peaking prices, rising mortgage rates. They basically were somewhat downbeat saying, this is it. Now, this is good news if you're out, looking for a house. People have been complaining about how stupid the prices have been for houses for a long time. Well, I think that's going to stop. The downside is mortgage rates are higher. So mortgage rates were 3.5%, a while ago. Now they're 5.5%. Still not terrible, but it's a tough game to play. But there's peak real estate. Then we saw Live Nation today. This is a company close to my heart because they own Ticketmaster, and I'm an old rock and roll guy, so I go to a lot of concerts, and the prices are stupid for concerts. Try going to any concert this summer, and you're going to be shocked at the prices you're paying. So I'm going to go see The Who at Madison Square Garden. I love The Who. I'm an old fan. They've been around for a million years, but, crazy prices, $300, really? You get a little annoyed. So I think this is going to be peak concerts. I think that this is, people are willing to spend anything just to get out for the summer. But let's see what happens in the fall when I think the economy is a little slower. I don't think it's going to be any recession this year at all, but I think people will be a little more careful, and I don't think you'll see these crazy prices. So that's kind of what I mean by peak everything, where, the pandemic created all sorts of strange bottlenecks, and now people are sort of exploding, going out, doing things, traveling, going to concerts, and willing to spend anything. I think there'll be a lot more scrutiny of that a little later on.
Yeah, that makes a lot of sense. And I mean, I was looking at prices for flights recently and I was just shocked at how much they have gone up. So I think that's relatable for a lot of people. Like you said, whether it's concerts,
Yeah.
travel, everything.
Live Nation said ticket prices were up 30%. They call it average per fan revenue or something like that. But it's at least 30%. I mean, that's amazing. I mean, we've seen airline prices up 50%. It's think about it. It's a lot.
It's really gone up a lot. So, Bob, like you said, it's been a busy week. We had the Fed meeting on Wednesday, and then today we had the April jobs report. So what does the jobs report mean for investors?
Well, it's good news. I was very happy with this report because there wasn't anything weird about it. Look, the thing you care about is the economy and inflation. So on the economy, the jobs are still strong. 420,000 months. We've had over 400,000 new jobs. We can't fill the jobs that are out there. You know all about this craziness about people walking away, people not even showing up for job interviews. By the way, that's another thing that's going to peak. That's not going to happen by the fall. Economy's going to tighten, and all these people, going around looking for new jobs, which I think is great. More money, great. You're going to find the labor market, I think, will tighten by the fall. So the jobs are still strong. And on inflation, they look at wage growth here. It was 0.3% month over month. They were expecting 0.5, so it was lower. Year over year, wage growth is 5.5%. That was in line with expectations. By the way, that's pretty good. But for a lot of people, it's barely keeping up with inflation. The good news on wage growth is the people at the lowest end are the ones who've had the biggest raises. So a lot of people were making $10 an hour, a year or two ago, making $15 an hour now. Those are big hikes. The people who are making more than that have gotten smaller jobs, wage increases. So I'm happy about that. The people at the bottom, if you're living anywhere in a major city, $10 an hour is $20,000 a year. There ain't nobody living in any major city on $20,000 a year. You're in your parents' basement, or you're growing your own vegetables on a farm your parents own. I mean, that's a very difficult to make a living on anything close to $20,000 near a major city. So I'm very happy that the low end wages have gone up. It's about time. So I vote yes. Money in the working man's pocket, more money. I vote yes on that. But inflation has eroded a lot of that over the last year. So we'll have to keep an eye on that. But just to answer the specific question, how was the jobs report today? It was excellent. Goldilocks, not too hot, not too cold. The market's in a bad mood, and it's for the reasons I told you about. Worried about inflation, worried about a slowing economy, worried about stagflation. So this didn't give them any new ammunition, but still a tough place for them.
Well, it's good to hear then that at least this was one bright spot that we've had recently. So Bob, our last question, with all of the market volatility that we've seen recently, what should investors do when stocks are plunging on a day like we saw yesterday?
Listen to the people who come on our air and talk. If you're a long-term investor, the answer is nothing. Jack Bogle, the founder of Vanguard, who's the man who had the most influence on me of anybody. I 32 years at CNBC, and one guy who had the most influence is Jack Bogle. Bogle used to quip, "Don't just do something, stand there." Most of the time, if you are a long-term investor and you have a plan and you understand what your age is, how far are you to retirement, how far are you going to live, and you understand risk tolerance, most of the time, the answer is do nothing. So let me be specific. Suppose you're 30 years old and you're putting money away every week a little bit. Trust me, what happens this year is not going to matter when you're 50 years old if you're a steady investor. And by the way, that's what I've been for. I'm up there. I'm in my late 60s. I've been doing this for a long time. I've been an investor too, a long time. Put money in through thick and thin for more than 30 years. And sometimes you just have to swallow it. The one thing I can assure you is market timing doesn't work. You think you know when to get out of the market and then get back in. You have to be right twice. You have to know when to go in and when to get back, when to get out, or the other way around. You have to know exactly when to go out and when to get in. And history shows people don't do that right. They can't, because the future is unknowable. even professional investors get it wrong all the time. We talk all the time about studies that indicate professional investors underperform their benchmark. Over a 10-year period, S&P does studies every year of active managers, professional people who try to figure out when to go in and out of the market. Over a 10-year period, 85% of all mutual fund active managers underperform the benchmark. Think about that. 85% underperform. Better for you to do nothing. Stay involved. Stay invested. Understand what your risk tolerance is. If you can't stand, if you have 75% of your money in the stock market and you can't stand it anymore, even if you're only 30 years old, and trust me, it's not going to matter. If you can't, then you need to change your risk tolerance a little bit and maybe reduce that amount. But trust me, if you're a relatively young person, it is not going to matter what happens this year, 20 years from now. It's not. Now, you may say, I can't take it, but that's a risk tolerance question. Just figure it out. Just understand broad diversification in the market. Even owning an S&P 500 fund is far better than you trying to pick individual stocks. And this is not just my opinion. This is people who go on our air who are long-term investors, who are professional investors and advisors will say this constantly. I know there's a stream of people picking stocks all the time. This is part of the business. People try to outperform all the time. Just understand what your long-term odds of you personally trying to do that and the success rate. The success rate is not great. Stay invested long-term, understand your risk tolerance, understand your age, how far you're going to be investing. If you're really uncertain, hire a professional to talk to you. And the one thing I would advise you on that is don't pay too much. Because what happens is if you end up paying 2% a year to somebody, that's an enormous amount of money to give up if the stock market is only going to go up 5% a year. Think about it. So you want to hire low-cost advisors. That's why ETFs are amazing. You can buy the S&P 500 for 3 basis points. You know what that is? That's $3 for every 10,000 you're invested per year. $3. For $3 a year for a $10,000 investment, you can own the S&P 500, the broadest sector of the market, okay? You can buy it through any one of many fund providers. IVV has the iShares, VOO, Vanguard has it, but 3 basis points. And that will get you exposure to the biggest stocks in the stock market. If you're paying 2% a year to a professional advisor and the market's only up 5%, you're surrendering 40% of your profits. Odds are they're not going to outperform. That's all that is the sum of the wisdom I had from watching and listening to Jack Bogle for more than 20 years.
Yeah, and Bob, I know in your time at CNBC, you've been able to talk to a lot of experts. So thank you for sharing that with everyone. And yeah, like you said, on a day like yesterday, it can be hard to do nothing, but your future self might thank you later on. Yeah. So thanks, Bob, for answering everyone's questions. Great questions as usual, everybody. So we appreciate it. And we'll talk to everybody again in a couple of weeks.
Thanks, guys. Take care.